Well, welcome to Making Money. I'm your host, Rich Adams. I have to say, the comment that markets will be volatile that I made in the last sort of video was spot on. We've seen the VIX over 30 pretty much for a whole week. We saw a 5% pullback on the S&P last week. All breadth has sort of disappeared from the market. Russell 2000 right down. Absolute carnage for small caps, and really just a few sort of mega caps really pushing along the index. So we've pretty much got the move in the market right on in our last video. So what are we seeing right now? Well, we're seeing sort of a bounce in the market and some sort of some very clear recovery in the major indices, and this sort of may continue. And there are perhaps two real good reasons to expect this to continue. First, a lot of the shorts have been shaken out, and secondly, I mean, a lot of people have finished with their tax loss harvesting. But my belief is that markets still remain expensive, and they remain at risk of selling off. And I think there are a number of catalysts for this. The most significant will come later in this week when we get the latest inflation print. I suspect we're going to have a very hot inflation print, and this will play into market participants' calculations about Fed policy. The Fed will meet on the 15th to decide what to do about asset purchases, and potentially to have some discussion about interest rates, and really a very hot inflation print might force the Fed's hand. They've already sort of intimated that potentially asset purchases might go down from 120 billion a month currently to significantly less in the first quarter of Q1, potentially falling 15 billion every month, but there is a suggestion now out in the press that asset purchases could decline by as much as 30 billion per month. So we could have a situation where we go from 120 billion a month currently right the way down to nothing by the end of March next year, and that would open up the way for the Fed to potentially hike rates. Now, so that I think is the principal catalyst, why I expect there to be something of a taper tantrum in the next few weeks. So whilst I might be missing out on a little bit of gains in the next few days, I have raised a lot of cash, sold down my equity positions, and I'm sitting on my hands waiting to see if I am going to miss out on a Santa Claus rally or potentially have some very good buying opportunities when the market sells off heavily because of a very sort of assertive Fed. You know, if the Fed were to cut asset purchases and then start talking about hikes, we really would have a very different environment. Imagine if in the first half of next year the Fed were to raise rates by 50 to 75 basis points, or more likely by the end of 2020 to raise rates by up to 75 basis points. I mean, imagine what that would do to the risk-reward calculus between stocks and bonds. You know, if you think about the Nasdaq, it's basically trading on a 30 PE, so an earnings yield of about 3.3%. If you suddenly have the short end of the yield curve shifting, that every asset is valued in relation to the attractiveness of other assets, and that really would, I think, cause multiple contraction for equity markets. So that's my sort of base case. Putting my money where my mouth is, and I am very strongly weighted towards cash. Maybe I'm right, maybe I'm wrong. I mean, if you look at the sort of key drivers of the market, really, you've had very narrow leadership. Those mega cap names, they've done very well with earnings. So right the way through the pandemic, your sort of Microsoft's, Google's, in particular, Apple and so on, they really earnings have been strong. So the suggestion that you might see in some of the press that earnings growth might be a bit weak next year, particularly because of Omicron, I could see that being true for many parts of the economy, but for the real market leaders, I suspect they would do quite well, irrespective of Omicron being moderately impactful to supply chains. So I think this is going to be less an earnings story, though I think earnings might be a little bit weaker than expected in H1, and more a story about interest rates, the discount rate on cash, and the present value future cash flows. So we'll have to wait and see. It's never a dull moment in financial markets, but my expectation is that we have a real pullback in the next few weeks, and I'm positioned to take advantage of that. So what should you do? Well, if you're going to follow me, raise some cash, sell some stock, and be a bit defensive. Thanks. Take care.